You're probably asking yourself, what is in the cards for mortgage rates, maybe in the next 30 days, because you might be looking to buy right now, maybe the next 3 or 4 months, and then the longer term projections. That's what we're going to talk about today. But to start off, we're going to look at the inflation numbers that just came in this week. And the most recent one was the wholesale price. That is basically the inflation level at the producer side of the equation. We're going to take a deep dive into this and much, much more. My name is Dan Free. I do this report on a daily basis to inform you guys what's going on in the markets. We have an emphasis on real estate. Why? I'm a mortgage advisor in all 50 states as well as Puerto Rico. So if you're looking to maybe get pre-qualified for a house or at least kick the tires and say, do I qualify for a house in today's market? Well, reach out to us. We'd love to help, and I'll give you all my information at the end of the video. If you're in an area where you're like, hey, I don't know if it's better to rent or buy, and you don't really know a realtor, we actually have a realtor vetting system that's free. And if you want to, just reach out to us down below. There's a link to schedule an appointment with us, and just schedule that link, and we'll set you up with a realtor in your area to make sure, is it a good time maybe to buy, or should you sit on the sidelines right now and rent for a little bit? So that's what we can discuss. But the headlines right now that just came out basically minutes ago was wholesale prices rose 0.3% in July, higher than expected. So the first thing, and the markets are reacting right now based on this, is bad. Okay, because they're saying, okay, will the Federal Reserve now raise rates? What's going to go on? But if you really dig in the details, and that's what I try to do on a daily basis, when you're diving into this, there's a number in here that's really confusing. What that number is portfolio management fees went up 7%, and it's the biggest piece or the biggest rise in this number. What is portfolio management? Well, I tried to do a lot of research, and I even dug into CNBC, and even those analysts don't know. They think it's how much money or how much it costs you to have a portfolio manager, taking over your assets. Well, a lot of us don't have that, so it's not going to affect a huge portion of us out there. So once these numbers really get dissected, I think it's going to be not as bad a news as the market's reacting right now, and we're going to get to that in a second. The other number that came in yesterday was the inflation numbers on we call it the CPI, the consumer inflation numbers. It came in at 3.2. I was kind of a little jittery on this. I thought it might come in at 3.3 or 3.4, so I was a little bit concerned. But what I want to do right now is walk you through the pieces of the puzzle in the CPI that I might not disagree, or I might disagree with, and then other areas that you might say, okay, that's fine because it might be toothpaste or something like that. So let's break in the details of the consumer CPI. And CNBC did this or put this out last night, and it's fantastic. I love a lot of the tools that they have. So I'll put this link down below for you guys to check it out. But right through here, they're breaking down. Here's the inflation breakdown for the July 2023 CPI numbers. You go through motor vehicle insurance, just went up 17%. Most of us or all of us have insurance, so you're going to see your insurance cost rise maybe, but that's one piece of that. Tax preparation fees. I don't know if you use an accountant, but if you don't, you're not going to see this increase. Food from vending machines. So if you're eating at vending machines, stop, because those prices are getting way too crazy. Motor vehicle maintenance. Then we have frozen fruits. Look at all the pieces of the puzzle right here that it's like, okay, what we want to focus in on though is rents for primary residency. Now, if you did a lot of research and you watch my channel on a daily basis, we know that rents are coming down pretty fast in a lot of areas. This number that I'm researching is showing the numbers about 7.4 to 7.6. You might say, Dan, who cares? They're saying 8. What's a big number? Why? Because the rents, or the rent equivalent of the shelter cost here, this makes up almost 40% of the CPI. So if the number comes in at 3.2, just a tick higher than what was expected, but this number is showing 8, but it's truly maybe 7.5. If you work this into the numbers, could inflation truly be right at 3 or maybe teetering in the 2s? Well, the market's going to analyze this, and it's going to be kind of choppy roads for the next couple weeks until the next numbers come out or Federal Chairman Powell comes out and starts giving us some guidance. But this is the areas that we want to really focus in on, and that's basically that piece of the puzzle. Then you want to go over here, and these are areas that are starting to come down. You can see butter, okay, medical care services, a lot of us are affected there, footwear, milk. They break it down really, really good right through here. So that's basically the breakdown of the CPI. If you're a geek like me on the economics, I'll put a link down below so you guys can analyze this. How are the markets affected by all this right now? Well, as soon as the PPI number came out, the markets basically were flat, and then they kind of started tumbling from there. But it's really, really choppy. NASDAQ was about -10, and now it's -90. So as the analysts really dive into this data, I don't think they're going to find it as shocking as it might be. So let's conclude basically what we saw this week. Basically what we're looking at right here is well, some good things here. Go back to Wednesday. Oil inventories. Previously, we had negative 17 million barrels. Okay, now we have a positive 5. Could this help oil? And that could really, really help in our inflation numbers. Then what came out yesterday, the CPI, we break these down. They all came in line with expectations. The employment numbers or the unemployment numbers or the initial jobless claims, this is maybe what the Federal Reserve might be high-fiving themselves about because they're wanting more and more people to lose their jobs. Why? So you stop spending as much as you are. And this is a good number for them there. And then we just had the PPI number, the producer prices, their inflation report. It was supposed to be, well, the last reading was 0.0000. This reading was expected to come in at 0.2, but it came in at 0.3. But remember, portfolio management fees went up 7%, and that's a big piece of this equation. So this number is going to get revised for probably the next 6 months. So teetering on 0.1s, it might guess it's not as bad as expected, folks. So let's get over to, is any of this news really affecting what the Federal Reserve might do at their next meeting? Because most analysts are saying they should be done. Well, what we do here is we watch the CME. The CME has a tool, that's Chicago Mercantile Exchange, that is FedWatch. They're expecting, what the Federal Reserve is going to do at the next meeting. The next meeting is 40 days away, 4 hours, 59 minutes, and 57 seconds if you're concerned. What is this tool actually? Well, it's what's the likelihood the Federal Reserve will change the federal funds target rate at the next meeting? Well, the current rate right now is 5.25 to 5.5. What's the probability that they're going to change that at the next meeting, or maybe the next meeting after that, or maybe the next meeting after that? Well, we go over to this report right here. Let's go to the probabilities right through here. Let me get my head out of the way so we can see this full chart. And when you break it down, here's the meetings. Okay, you can see at the top, federal funds futures, meeting probability. We have the next meeting coming in at 9/20 of 2023. 88% probability it's not going to change. The following meeting in November is about a 70% chance. This is probably going to reduce as we get closer and closer to this, because I'm expecting the CPI and the PPI numbers to keep continuing to come down. And then we're going to see basically rates flatline right there. But here's the interesting point. A lot of people are asking me, Dan, what's going to go on with mortgage rates or rates in general over the next, maybe 3 to 6 months? Well, here's the probabilities of what's going to happen. This is what they call the dot plot. What the dot plot is basically every FOMC participant, so the Federal Reserve members, there's one grand poobah, that's Federal Chairman Powell, but there's a lot of other federal people on the Federal Reserve. And every meeting that they meet, they kind of put a dot on where they expect the federal funds rate to be. The interest rates that the Federal Reserve controls. Here's where they are right now. They're expecting it to be about 5.5 to 5.75. So there might be one more rate increase in the cards. A lot of analysts are saying no, the Fed's not going to do anything else. I'm in that camp as well. But let's just project out just the next 6 to 12 months. Here's where they're expecting to be. So if you look through here, where's the most amount of dots? You go through here and it's about 4.25. Okay, well, if we're at 5.25 right now, 5.25 to 5.5, that means the Federal Reserve's most likely, and even in their words, going to pivot within the next probably 6 months. Okay, so that's the projections on where we're expecting mortgage rates and rates to be in general. So you guys might be asking, and the people ask me all this all the time, Dan, should I just wait till next year? So here's what my suggestion would be, or my hypothesis. There's a lot of demand for housing. We know that in the demand features. I have people calling every day and then they freak out. They're like, I can't find a house in that price range. That interest rates puts me into a payment that's a little bit higher than I want. But a lot of people are doing that. Okay, so what's going to happen is when rates start to teeter back down, and they're going to come down even based on the Fed's news, a lot of people are going to jump in back into the market. So what are you going to see? If you have a ton of people jumping back into the market, what's going to happen? Prices are going to keep going up, okay, and up and up. Why haven't we really seen a crash? And I represent a crash about 30% in values of homes. Why haven't we seen that? Well, because there's no supply. There is really no supply. My neighborhood consists of about 150 homes. I think there's 2 of them for sale. Okay, so there's just nothing out there. If you want to buy a house in that area, unfortunately, you're going to have to pay whatever that person's asking. But that basically that's what it is. So this is what's going to happen. So you guys, please reach out to us. Kick the tires. See, what do the numbers look like? Can you swing it right now? Because the probability in about a year, rates are going to be about a 1 to maybe even 1.5% lower at that time, and that's when you might be able to refinance and save hundreds of dollars a month on your payments. So with all this news coming in, what is effect of this is it having on mortgage rates and the bond market? It's not good, folks. You're seeing right through here. This is what we focus in on, the MBS market. What is it? What's a mortgage-backed security? It's a bond that trades on Wall Street that basically determines the yield or the rate on your mortgage. This is what's going on with the price, okay? All I got to say to you is the price goes down, rates are going up. There's a yin-yang effect, a reverse effect on this. This number means that rates are probably going to go up about 0.25% today, putting us where? Well, maybe at the equivalent to the last 52-week highs. So these are rates published by Mortgage News Daily on a daily basis. And the basis of these rates are if you're buying your first house, it's a primary home and a single-family home. So it's those 3 criteria. You have a 740 credit score, and you're putting 20% down. Not 5, not 3, not 10, 20% down. This most likely is what your rate's going to be. If you look here right now in the 30-year fixed, we're at 7.14. Now, these aren't my rates. These are more the average rate across the whole country. But if you add in another 0.25 point there, will we be at or equal to the highest rates that we've seen in the last year? Probably. So hopefully you locked in. If you haven't, please reach out to us and let us give you a mortgage quote. How do you do all this and reach out to us for some advice? Well, like I said, my name is Dan Frio. I do this report on a daily basis. I'm a mortgage advisor, have been doing it over 30 years and would love to help you. How do you reach out to us? Right here. Give us a call, 844-775-LOAN, 844-775-5626. Or you're like, Dan, oh, by the time I get home, you guys are closed. What can I do? Well, if you hit the apply now button, what we did over there is we changed that from an application basically to a consultation. So you can schedule an appointment with me or one of my mortgage advisors. We're going to answer any and all the questions that you have. And if they're minute questions, then we'll just do a couple questions, be on and off the phone in about a minute or 2. Then we'll send you your link to get started on your mortgage application to see if you can get qualified to buy a house in 2023. Thanks so much for watching, guys. I'm going to ask you one thing today, and it helped yesterday. If you haven't subscribed yet, please subscribe to my channel down below so I can get found by more and more people that might be looking to buy a house in 2023. God bless, folks. Thanks so much for watching. Have a great weekend. See you next Monday. Take care. Bye-bye.